Hello everyone. My name is Vaibhav Puranik, and today I'm going to talk about how the new One Big Beautiful Bill affects your taxes, and especially in the real estate and multifamily investing segment. So there's like six, seven different things. So I'll go one by one and explain each of the changes and their impact on you. This is one of the very important video. I think you should mark it, save it somewhere, and then ask meaningful questions to your CPA about it. So the first one is SALT deduction. SALT means state and local taxes deduction. So Senate's version of the bill, which ended up passing, have a SALT deduction of $40,000. But there's a catch here. If your MAGI or modified adjusted gross income above $500,000, then it starts to phase out. So until then, it's 20,000 for each. So if you're a joint married filing jointly, then 20 plus 20, 40,000 is what you get. But after 500,000 MAGI, it starts to phase out, and at $620,000, it completely goes away. And what that means is, if your MAGI is above 620,000, essentially you have $10,000 deduction only. That means this bill changes nothing if your modified adjusted gross income is above $620,000. If it is below 500,000, then you get 40,000 SALT deduction. If it's between 500 and 620, then there is some phase out formula that you should ask your CPA. Okay, so that's the main change in the SALT deduction. Now, generally SALT deduction is not used for investments. I mean, this is not an investing topic. This affects everybody because the property taxes you pay and state local taxes you pay, all of that stuff. So now let's move on to investing related topics. One big change that has come in is about the bonus depreciation. So there was what we can do is when you own a real estate, generally in residential real estate, IRS allows you to depreciate a property over 27.5 years. But then if you do cost segregation study, you can depreciate some of the appliances and equipment over smaller amount of time, like 15 years. And then in the last term of President Trump, they allowed bonus depreciation. They allowed 100% bonus depreciation to be used, okay, to write off these things. That was fading away, right? Now that has been reinstated until 2029. And that means if you do a cost segregation study now, you will be able to claim 100% bonus depreciation as long as the asset has been placed in service after January 2025. So if your asset has been placed in service before that, you might not be able to use it. Again, check with your CPA. These things are complex, and I'm not a CPA. So please consult with your CPA before making investment decisions. So this is a very big help, essentially, right? And what this means is you can now write off full cost of eligible improvements immediately. And again, time is critical. You have it until 2029, and after 2030 the phase out starts. Now let's talk about uh, another aspect, which is the permanent corporate and pass-through tax cuts. So, well, first of all, corporate tax rate, right? The corporate income tax rate remains permanently set at 21%. Um, Continuing the rate reduction first established by the 2017 Tax Cuts and Jobs Act. So it was going to go away, now it has been reinstated. Then there's a pass-through business deduction, okay, and that means it increases this bill increases and makes uh, permanent the deduction for qualified business income from pass-through entities like LLCs, partnerships, S corporations, to 23%, up from 20%. So QBI has been increased to 23% from previous 20%. So this means for real estate investors, you can deduct 23% of your net rental income from your taxable income. Again, this means that you can deduct 23% of your net rental income from your taxable income, lowering your effective tax rate on that income to about 28.5% from 29.6%. So this is a good news for rental property owners or people who own property through syndications and other ways. Yeah, and similarly, like this 23% reduction also applies to qualified REIT dividends as well. So if you're investing in REITs, then you might be eligible for this benefit as well. So yeah, I mean, the impact of that, it lowers your overall taxes, especially if you have rental properties or if you are participant to a syndication or an LLC or a partnership that's dealing with real estate. Now let's talk about another tax thing, which is the estate tax. Now, a lot of real estate investors, right, keep their real estate forever, and then they want to pass on that real estate to their heirs. So this now when you pass on like a really, really high value item, or well, really you pass on a lot of money to your heirs, right? Uh, it can become taxable. So the previous limit for having tax-free pass on to your heirs was about 13.9 million. Now it has been increased to 15 million. That means up to $15 million you can pass on to your heirs without having any tax implications. And so for married couples, it's $30 million, which is amazing. Now you should check with your estate attorney because if you have already done some of these, if you have already given some money or some assets to your heirs, then it might count towards that 15 or $30 million. But yeah, I mean, it makes it easier for affluent families to transfer wealth, right, to their across generations. Okay. Now, let's talk about the impact of one big beautiful bill on affordable housing. And there is two areas in affordable housing which has been touched especially, right? And one is the Section 8 housing. And if you don't know what Section 8 housing is, in Section 8 housing, the federal government gives renters some sort of vouchers, and they essentially pay their partial rent, especially if this is true for lower income families. So it's not explicitly said there, but from what I could make out from everywhere is that the Section 8 funding has been cut actually. Okay, we don't know how much exactly has been cut, and the more responsibility has been pushed through states. And what that means is that if your state government is in trouble, then they could cut funding further. So my advice to real estate investors is that don't buy properties that are entirely made up of Section 8 tenants, because then the federal government assistance has been reduced, and now um, the more responsibilities has been pushed to the state, and if your state is not doing well, then you might suffer more. So I mean, a little bit of mix of Section 8 tenants is okay, but if your entire property is made of Section 8 tenants, then I think you are at risk. Then you should look at how to improve that property, how to so that you can make it appealing to the general population instead of just Section 8. But at the same time, the bill also provides for affordable housing, but it provides for a different way. So there used to be a thing called low income housing tax credit, okay, which is called LIHTC, and this is a federal tax incentive for real estate developers to create affordable housing, rental housing. So what one big beautiful bill does, it permanently increases the LIHTC state allocation to 12%, and it lowers bond financing threshold to 25% starting 2026. Now I don't understand bond financing part really well, but the impact of this is that there are more tax credits are available for new affordable housing development. And that means making LIHTC deals more attractive and potentially more competitive. So if somebody comes to you about investing in LIHTC properties, then examine it carefully. The return might be higher than it used to be there. Um, so that's about affordable housing. Now let's talk about opportunity zones. So opportunity zones used to be these, let's say, designated areas in which if you buy a rental property there, or if you buy some sort of asset there, you invest there, right? Then there used to be a deferral on capital gains tax when you sell it. So there are some interesting changes. That opportunity zone program was going to get phased out from December 31st, 2026. Now this opportunity zone program has been made permanent. So that is a very interesting thing. It has been made permanent. Every 10 years, the governor of the state will designate opportunity zones. Um, and then, not only that, if you hold these properties for 10 years or more, then you are exempt from capital gains tax. That means you can completely save capital gains tax. So this is a huge impact in my opinion. That means if you are an investor, go look for properties in opportunity zones. Invest in opportunity zones, right? And hold that property for 10 years, and then you don't have to pay any capital gains tax when you sell it. Now, the last one I have here is the energy efficiency credits. Now, unfortunately, they have been phased out. So these were tax credit for installing like solar panels, high efficiency HVAC, uh, energy saving windows, stuff like that. Uh, so Section 179D and 45L credits have been phased out starting June 30, 2026. And no credits for projects placed in service after December 31st, 2027. So the impact is if you are planning these green upgrades, then hurry up. Uh, Act quickly to capture remaining credits. Uh, Future projects will not get these tax breaks, right? So adjust your budgets accordingly. Don't bank on them anymore. Okay. So now what I'm going to do is I'm going to summarize all these things. So based on all of these things, like what are our recommendations to multifamily investors? So of course, number one recommendation is that diversify your tenant mix. Don't rely solely on Section 8. Um, include market rent and other types of tenants to just reduce your risk. Explore low income housing tax credit opportunities. Um, Take advantage of those tax credits. Maximize bonus depreciation. So use cost segregation study and write off as much as you can to save taxes. Um, Update your estate plan. Leverage the higher estate tax exemption to pass down real estate efficiently. Um, for energy upgrades, move quickly. Right? Use whatever is left over and complete your projects. And again, stay informed with all these changes because these things keep changing. So you have to be on top of it. You have to nag your CPA, hey, explain me what it is, and try to understand from them how it exactly impacts you because your situation could be different. And that's why uh, what I've told so far is just it's for general education purposes, right? It is important that you reach out to your CPA or tax professional and understand its implications on you. Again, for more informative things like that, please subscribe and share our YouTube channel, which is Old Money Capital. We also have various social media channels. We have a podcast, and our website is oldmoneycapital.com. There's a lot more stuff that's coming out about one big beautiful bill and its impact on multifamily investors through all of these mediums. So keep following us, and thank you very much for listening.